Did you know that during the Great Crash of 1929, the stock market lost almost 90% of its value over 3 years? Imagine waking up one day to find your investments worth a fraction of what they were. It's a nightmare scenario, but it happened. In one single day, October 29, 1929, known as Black Tuesday, the market fell by 12%. Millions of people lost their life savings, and the ripple effects were felt worldwide. What caused this financial disaster? More importantly, what can we learn from it? The Great Crash wasn't just a financial meltdown, it was a perfect storm of mistakes and misjudgments. From panic psychology to margin madness, and from speculative bubbles to misguided government policies, there are countless lessons to be learned. In this video, we'll uncover 12 crucial tips from the Great Crash of 1929. We'll explore how to understand investor behavior during crises, the dangers of leverage, the true value of diversification, and much more. Each chapter will give you practical strategies and fascinating insights that you can use to make smarter investment decisions today. Ready to dive into the depths of history and emerge with timeless wisdom? Let's get started. Chapter 1. Panic Psychology. Understanding Investor Behavior in Crises. The Great Crash of 1929 was a profound lesson in investor psychology. One of the biggest triggers of the crash was mass panic. People saw prices dropping and rushed to sell, making the situation worse. This behavior is called herd mentality. Investors followed others without thinking critically. John Kenneth Galbraith, in his book, The Great Crash 1929, explained that fear spread like wildfire. Everyone was selling, so others felt they had to sell too. To avoid falling into this trap, it's crucial to stay calm during market downturns. Remember, panic leads to poor decisions. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Keeping this in mind can help you make more rational choices. Another strategy is to have a clear plan before market turmoil hits. Know your investment goals and stick to them. Don't let emotions drive your decisions. Diversifying your investments can also reduce panic. When you have a variety of assets, a drop in one area doesn't hurt as much. Chapter 2. Margin Madness. Lessons on Leverage and Risk. In 1929, many investors bought stocks on margin, meaning they borrowed money to buy more stocks. When the market crashed, they couldn't pay back their loans. This led to massive financial ruin. The lesson here is clear: be cautious with leverage. Using borrowed money can amplify your gains, but it also increases your risk. A good rule of thumb is to only use leverage if you understand the risks fully. Don't bet more than you can afford to lose. Diversify your investments to spread risk. The less concentrated your investments, the safer you are. Ben Graham, the father of value investing, warned, speculating with borrowed money is dangerous. It's also wise to have a buffer. Keep some cash reserves to cover any unexpected losses. This safety net can prevent you from having to sell assets at a loss. Leverage can be a powerful tool, but it must be used carefully and sparingly. Chapter 3. Diversification Myths. The True Value of Spreading Risk. Diversification is often misunderstood. Many people think that simply having different stocks means they are diversified. However, true diversification means spreading investments across various asset classes. During the Great Crash, even diversified portfolios took a hit. This shows that while diversification can reduce risk, it doesn't eliminate it entirely. One strategy is to include bonds, real estate, and other asset classes in your portfolio. This way, if stocks fall, other investments might hold steady or even rise. Ray Dalio, a famous investor, calls this the holy grail of investing. He suggests having 15 uncorrelated investments to maximize return and minimize risk. Another tip is to diversify globally. Investing in international markets can protect you from domestic downturns. During the 1929 crash, markets worldwide were affected, but not all to the same extent. Having global investments can help balance your portfolio. Chapter 4. Market Sentiment. Reading the signs of economic euphoria. Market sentiment plays a huge role in investment decisions. In 1929, there was a widespread belief that the stock market would keep rising indefinitely. This euphoria led to reckless investments and eventually, the crash. Understanding market sentiment can help you avoid getting caught in bubbles. One way to gauge market sentiment is through the price-to-earnings (P/E) ratio. When this ratio is unusually high, it might indicate overvaluation. Another indicator is the VIX, also known as the fear index. It measures market volatility and can signal investor anxiety. Being contrarian can also be beneficial. When everyone else is optimistic, it's a good time to be cautious. And when everyone is pessimistic, look for opportunities. Sir John Templeton, a renowned investor, said, "The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." Paying attention to economic indicators like GDP growth, unemployment rates, and interest rates can also provide insight into market sentiment. These factors can influence investor behavior and market trends. Chapter 5. Liquidity lifelines, ensuring access to cash in downturns. Liquidity was a huge issue during the Great Crash of 1929. Many investors didn't have enough cash on hand when the market plummeted. They had to sell their stocks at a loss to cover their debts. This scenario highlights the importance of having liquid assets. Keeping some cash in reserve can help you avoid forced sales during downturns. One strategy is to maintain an emergency fund that can cover 3 to 6 months of living expenses. This fund should be easily accessible and not tied up in the market. Another approach is to invest in assets that can be quickly converted to cash, like short-term bonds or money market funds. Diversifying your sources of liquidity is also wise. Consider having multiple streams of income. This can include dividends, interest from bonds, or rental income. Having these sources can provide a financial cushion during tough times. As the saying goes, cash is king. Chapter 6. The Aftermath Advantage, finding opportunities in market declines. After the Great Crash, smart investors found ways to profit from the chaos. They identified undervalued assets and bought them at bargain prices. This strategy is known as value investing. Benjamin Graham, the father of value investing, taught that the market is like a voting machine in the short term, but a weighing machine in the long term. This means that prices can be irrational in the short term but tend to reflect true value over time. Look for companies with strong fundamentals that are temporarily undervalued. Check their balance sheets, income statements, and cash flow statements. These companies are likely to recover and grow in value. Another tip is to buy during market downturns. When others are selling in panic, it's often a good time to buy. Patience is key. Hold onto your investments until the market recovers. This might take time, but it can lead to substantial gains. Remember, the stock market rewards those who are patient and disciplined. Chapter 7. Speculation versus investment, drawing the line. The Great Crash of 1929 was fueled by rampant speculation. Many people were buying stocks not based on the company's fundamentals but on the hope of quick profits. This speculative bubble eventually burst, leading to massive losses. Understanding the difference between speculation and investment is crucial. Investment involves thorough research and a long-term perspective. You're buying a piece of a company because you believe in its future growth. Speculation, on the other hand, is more like gambling. It's based on short-term price movements and market trends. Warren Buffett, a student of Benjamin Graham, famously said, "The stock market is designed to transfer money from the active to the patient." Focus on the intrinsic value of the investments rather than their current market price. This approach reduces risk and increases the chances of long-term success. Chapter 8. Economic indicators, using historical data to predict trends. Economic indicators can provide valuable insights into market trends. Before the 1929 crash, there were several warning signs, such as rising unemployment and declining industrial production. Understanding these indicators can help you anticipate market movements and make better investment decisions. Keep an eye on leading indicators like the stock market, manufacturing activity, and housing starts. These can signal the direction of the economy. Lagging indicators, such as unemployment rates and corporate profits, confirm trends that are already underway. Using historical data can also be informative. Look at past market cycles and economic conditions. While history doesn't repeat itself exactly, it often rhymes. By studying previous crashes and recoveries, you can identify patterns and make more informed decisions. Stay updated with economic news and reports. Subscribe to financial publications and follow trusted analysts. This continuous learning process will help you stay ahead of market trends and avoid potential pitfalls. Chapter 9. Psychological fortitude, building resilience against market volatility. Market volatility can shake even the most seasoned investors. During the Great Crash of 1929, many investors panicked and sold their stocks at a loss. To avoid this, building psychological resilience is key. Understanding that market ups and downs are normal can help you stay calm during turbulent times. One strategy is to focus on the long term. Markets historically recover from downturns. The S&P 500, for example, has an average annual return of about 10% over the last century, despite numerous crashes. Keeping this perspective can help you stay the course. Diversifying your investments also helps. When your portfolio includes a mix of asset classes, you're less likely to be heavily impacted by the poor performance of a single asset. This can reduce stress and help you stick to your investment plan. Mindfulness and stress management techniques can also be beneficial. Practices like meditation, yoga, or even regular exercise can improve your ability to handle stress. Remember, a calm mind makes better decisions. Chapter 10. Government Interventions. Impact on Markets and Investments. Government interventions played a significant role during the Great Crash of 1929. Policies like the Smoot-Hawley Tariff Act worsened the economic situation by reducing international trade. Understanding how government actions affect markets can help you make informed investment decisions. One strategy is to stay informed about policy changes. Follow news on interest rates, trade policies, and fiscal measures. These can have immediate and long-term impacts on your investments. For instance, lower interest rates often boost stock prices, while higher rates can have the opposite effect. Another tip is to consider how government spending affects different sectors. Infrastructure projects, for example, can benefit construction and manufacturing companies. Similarly, healthcare reforms can impact pharmaceutical stocks. Diversifying your portfolio to include investments in different regions can also provide a hedge against local policy changes. If one country's policies negatively affect its markets, investments in other regions might perform better. Chapter 11. Learning from Mistakes. Avoiding the Pitfalls of 1929. The Great Crash of 1929 provides numerous lessons on what not to do. One major mistake was excessive speculation. Many investors bought stocks based on hype rather than fundamentals. Avoiding this pitfall is crucial for long-term success. Always do your homework. Research companies thoroughly before investing. Look at their financial health, management team, and competitive position. Peter Lynch, a famous investor, said, "Know what you own, and know why you own it." This approach reduces the risk of buying overhyped stocks. Another common mistake was lack of diversification. Many investors put all their money into a few stocks. Diversifying across sectors and asset classes can reduce risk. During the crash, those with diversified portfolios fared better than those heavily invested in one area. Regularly review and adjust your portfolio. Market conditions change, and so should your investments. Rebalancing ensures your portfolio remains aligned with your goals and risk tolerance. This proactive approach can prevent significant losses. Chapter 12. Legacy of the Crash. Long-term perspectives on wealth building. The legacy of the Great Crash of 1929 offers valuable long-term lessons. One key takeaway is the importance of patience. Markets will have ups and downs, but those who stay invested tend to do well over time. The crash taught investors to focus on the long term and avoid short-term speculation. Compounding is another powerful concept. Reinvesting dividends and capital gains can significantly increase your wealth over time. Albert Einstein reportedly called compounding the eighth wonder of the world. It's a simple but effective strategy for building wealth. Consistency is crucial. Regularly investing small amounts can add up over time. This strategy, known as dollar-cost averaging, reduces the impact of market volatility. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. Learning from history can help you avoid past mistakes and make better decisions. The Great Crash of 1929 was a harsh lesson, but it provided invaluable insights for future generations of investors. By applying these lessons, you can build a resilient and successful investment portfolio.